The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.
Hi, this is Fletcher Wheaton from Real Estate Without Borders. You're tuned in to Dream Chasers, interviews with the future.
When you get into raising money or raising capital, you're really dealing with the Securities Acts. When you get into advising people, now you're talking about the Investment Advisor Act. And so when you start to get into this area where you're raising money and investing in another fund that is then making decisions on how to deploy that capital, now you're really relying on other people's investment advice.
Right now, while it's fresh in your mind, go to raisemasters.com. That's raisemasters.com. On that website, you'll find that we have an upcoming webinar that will teach you 3 capital raising strategies for free. No, this is not some kind of watered down presentation that's no good. These are groundbreaking, new age capital raising strategies that are meant to be learned in the order in which we give them to you. And we sincerely believe that if you take the time to learn these strategies and implement what is taught, the next 90 days of your life will be fantastic. Again, it's free. There are no tricks to this presentation, by the way. Go to raisemasters.com and register while the getting's good.
This is Dream Chasers, episode 165, with Marc Cesar and Byron Elliot.
Hey guys. Hi Grandma. This is Adam Carswell, and welcome to Dream Chasers, interviews with the future. On Dream Chasers, we bring next level talent to the light. Thank you for tuning in. Now let's get straight to the interview. All right, we are live, ladies and gentlemen. Welcome to another amazing episode of Dream Chasers, interviews with the future. On Dream Chasers, we bring next level talent to the light. Hi, Grandma, by the way. Hope you're having a great day and enjoying this interview with us as well. I've got Marc Cesar and Byron Elliot on the line here today. I guess we'll actually start in the other order. Byron Elliot, who's really our source or hub of knowledge today. He's an attorney and a real estate entrepreneur. I've had the pleasure of getting to know Byron through Raise Masters, the #1 mastermind for elite capital raisers. Just someone who, plain and simple, he knows his stuff. And I know multiple people that can validate that, including our good friend Hunter Thompson. And then we've got Marc Cesar here as well, who's also a real estate entrepreneur and a meetup host. He's the host of, and I had you pulled up on my big screen here for a second, Marc, and now I'm trying to read it because I put it to, I can see your little window. Financial Freedom Investing, right? Did I get it right?
Yeah, financial freedom through apartment investing.
Through apartment investing. Now I can see it because you're nice and big on my screen there. There we go. Awesome. So anyways, yeah, and I met Marc. For those of you who are not familiar with him, I met Marc about 6 months ago or so, and I just noticed out of anyone who was kind of in the inception phase of getting into this industry, he really seemed like someone who's taking it serious. He's hungry. He's out there posting consistently, hosting a meetup, doing everything that I think, especially from a bootstrap perspective, you'd like to see in someone who you know is just going to crush it if they stay consistent. So Marc actually went out and aggregated a nice list of questions that we're going to run by Byron today, because, you know, getting guys, this is Byron. Are we allowed to ask what your hourly rate is now? Because that's pretty much the amount of value we're going to be given here today.
Yeah, we typically do flat fee on our offerings, so you guys can work it into your budget. But I would say a securities attorney anywhere from $280 to $650 an hour.
There we go. Well, we're going to take the high end on that. So, ladies and gentlemen, this is a $650 episode delivered to you on a silver platter. And, you know, with that being said, let's actually, you know what, before we dive in, it's always helpful to paint a little bit of context. So Marc, if you could kind of share your real estate and capital raising journey with our viewers and listeners, we'll shift over to Byron and then we'll get into the fun stuff.
Sure. Thanks you, Adam. I appreciate being here and amongst you and Byron. So basically, just to keep it brief, my journey started as a wholesaler back in 2015 on the residential side, pivoted over to the multifamily space in 2018-19. I'm currently looking to get my first deal done in the space. It's a very interesting journey. I'm learning a lot, and I'm very sure I will learn a lot about the topic that we're going to be discussing today, which is capital raising and, all the in-between stuff that a lot of people might be pondering. So if you guys have any questions, feel free to jump on the live and on Facebook, and feel free to drop in your questions. We're looking for it to probe a very awesome mind right now. So take advantage of it, everybody. And again, thank you for being here, Adam.
My pleasure, Mark. My pleasure. And thank you for the context and the big picture. So Byron, let's hear the life story in 30 seconds, and then we'll get into it.
Thanks for that. Thanks for the introduction as well. So we have a small boutique firm just south of Denver, about 20 miles south of Denver, a town called Castle Rock. We've been working with real estate entrepreneurs now for 4 years and some change in terms of helping raise money, entity formation, and whatnot. And then on the personal side of the house, we also invest both as an operator. So we've raised money now 3 times for 2 mobile home parks and a mixed use facility. And then we kind of specialize in a certain region on the southwestern side of Colorado, primarily in historic buildings. So using tax credits and some other incentives to put together deals that otherwise probably wouldn't pencil, but pencil pretty nicely now.
There we go. Well, some great markets to be in, and always helps to know another, potential set of boots on the ground. So guys, if anything Byron shared this just there catches your attention, don't be shy. You reach out to, we'll get the information here later, but you can definitely reach out to him, myself, or Mark. And those links are coming your way later in the interview. But here we go. Let's go ahead and dive in. We got the $650 an hour opportunity here, Mark. So you want to share with Byron some of the questions that you were able to prepare for today's interview?
Sure. So one of the questions that we have, Byron, is, are there different rules for a fund of fund based on what state? And if it's based on what state you're in? Hope I asked that correctly.
Can you restate the question one more time?
Sure. So the question basically states, are there different rules for a fund of fund based on what state you're in?
So that's a great question. There's a couple steps to that analysis. The first question is how you raise money, right? And so most people are familiar, especially up and comers, on how to utilize Reg B exempt offerings to either a 506B or 506C offering. I think we'll get into that here in a little bit. And then the second level of that analysis is what is the type of fund that you're investing in? Is it something where you are pooling monies together from your group of investors and taking advantage of an opportunity that is clearly identifiable? Is it with a fund that has a very specific investment criteria and has disclosed what the acquired fund fees are? So the reason that's significant is when you get into raising money or raising capital, you're really dealing with the securities acts. When you get into advising people, now you're talking about the Investment Advisor Act. And so when you start to get into this area where you're raising money and investing in another fund that is then making decisions on how to deploy that capital, now you're really relying on other people's investment advice. If you're raising money to invest in a fund that has a very clearly identifiable investment criteria, they're investing in a particular asset, whether it's a piece of real estate or a particular industry, and there's plenty of information there for your subsequent investor to invest, you're staying, in that case, out of the realm of the Investment Advisor Act. So in a typical attorney answer, it depends, right? It depends on where you're raising money, and then what type of fund you're gonna deploy that money into. Does that make sense? But at the end of the day, you're definitely going to want to take a look at the various securities acts at the state level.
Awesome.
What I guess can we potentially go a little deeper there? Because Marc, I know you're looking at some deals in some hot markets right now. I mean, do you think could we do a state specific question?
Sure. I mean, we don't have any state specific questions.
Well, we'll circle back to it. We'll keep moving. My bad. Couldn't help but get a little curious. Keep going.
So the next question we have, are there certain certifications a person needs to be a fundraiser?
So I think what we're looking at there is the distinction between somebody who's an operator or sponsor of a deal, and then a third party who is compensated to raise money for you, right? So this is the biggest issue here. We've talked extensively about broker dealers. That's the big concern. So at the high level, if you have somebody, and it's whether they're in your organization, whether they're a principal in your special purpose entity, or whether it's a third party, if somebody's being compensated for bringing money to the table for you, that could be construed as a broker-dealer relationship, which would require registration with the SEC. So to be a broker-dealer, there's a battery of tests that you have to take. There's registration requirements. And there's a lot of discussion on this, even when you talk about the principals or employees of a potential sponsor. So when you're taking a look at the principal and the sponsor, or an employee, let's say, who's paid for marketing and advertising, amongst other activities, if the SEC was going to take a real hard look at the activities of both the employer, the principals, they would want to take a look at, are they being paid just a flat fee, like a salary, or is there a compensation? Is there an escalator for the amount of money they bring to the table? Now, it's interesting right now, the SEC has proposed a rule to ease up on the restrictions of what they're calling finders, or basically people who help bring relationships to sponsors or issuers. So they're trying to clear up some of the confusion right now. I believe they're in the part of the rulemaking where they're taking opinions from other people who are well-versed in the industry. People have been doing this for a long time, and they're trying to basically ease up the restrictions on people who can make introductions, especially for smaller startups.
Awesome. So now, this is a question slightly based on what you were saying with broker dealer. I know the SEC was very strict in regards to broker dealer, and so where as an individual, let's say myself, for example, if I didn't want to have any part of the deal, but I simply introduced, let's say I introduced Adam to another operator who has a deal on the table, and I know Adam has the money, is that still frowned upon by the SEC, or is that something that they're more lenient to now? Whereas, I can introduce, Adam to an operator, and he has the money, and they simply just pay me a commission or a referral fee, so to speak.
Yeah, so I know there's some confusion about that. Part of the reason is there was a case, I think it's called the Dominion case, where in a very narrow circumstance, a person could be compensated for making introductions. And I think the considerations were you handing out literature? Were you giving advice about the particular deal? Those are the kind of things that fall outside of just a finder, so to speak. But they actually rescinded that opinion because it did create more confusion, right? It's a very slippery slope if you're introducing somebody, even if you're not being compensated for whether or not they invest. a nominal fee for making introductions could be construed as compensation. And so it's a gray area for sure. Part of the challenge and part of I think the reason that SEC is looking to make a smaller exemption is the certification you need to be an actual broker dealer who would register with the SEC requires a series of tests that may not be applicable to what you would be doing as a finder, so to speak, right? Learning about mutual funds and stocks and all kinds of other securities seems like a lot of schooling and a lot of time commitment for somebody who simply has a good network who wants to make introductions and who would benefit from that. So I think they first proposed this back in October of 2020. The rulemaking process is fairly long. And so I wouldn't be surprised, though, if near the end of 2021 or into 2022, they enact some rules that ease up on that restriction.
Awesome. Great to know. So the next question we have in the queue is, what is the structure that's needed to be in place when putting together a fund of funds?
So when we say structure, I think there's a couple things, right? One, you're looking at the legal entity, right? So you've probably heard the term special purpose vehicle, special purpose entity. So basically that's a legal entity that's formed, typically for the purpose of investing in, let's say, another fund. That could be a number of different types of entities, really popular limited liability companies, very flexible. You can do non-pro rata distributions and allocations of loss. You can elect to be taxed as a partnership, or I guess that's the default. If it's a multi-member LLC, your default is you're taxed as a partnership. If it's a single member, it's considered a disregarded entity in most jurisdictions, but you're forming some entity. And more often than not, what you're selling are membership interests in that entity. And so when we're doing that, you typically have a lot of people refer to the person who's calling the shots on the LLC side of the house as a manager. A lot of times people use that synonymously with a general partner, but to be most appropriate, a general partner is calling the shots in a limited partnership or a limited liability partnership. But effectively, those are the two types of entities that people are using, and those are the two kind of shot callers in that organization. And so you would take a look at what your distribution plan is based on whatever financial modeling you have going on, and you would write up offering documents. So typically, we're talking about a private placement memorandum and either an operating agreement in the context of an LLC or a partnership agreement in the context of a limited partnership or a limited liability partnership. And you're basically going to sell off interests. So you're actually selling a security as well. So fortunately, you have these two exempt offerings that we talked about where you can do that. The requirements in terms of filing with the SEC are minimal. You file what's called a Form D. Basically gives you kind of the minimum and maximum, the offering that you're going to make, maybe where you're going to sell your securities. You disclose what kind of fees are going to be earned for the job that you're doing. You'll typically identify the principals of those companies in your Form D filing. And after you actually start taking money, you have state notification requirements. You've heard of probably blue sky filings, but the 506B and 506C offerings are federal law that actually preempt state law. But in this case, they've allowed states the opportunity to require notifications and to collect filing fees. And so you definitely want to be mindful of that and make sure you work that into your budget. Some states don't have filing fees or state notification requirements. Others are pretty expensive. I think New York, right now is at $1,200 a pop per filing. So, I mean, depending on the size you raise, that could be significant. These membership interests that you're selling, typically they grant the general partner or the manager almost absolute discretion. So, they're making decisions on where to deploy the capital. They're making decisions on, in the case of real estate, what properties to buy, what's the hold period. Again, ideally, you disclose your business plan as much as possible so the investor can make an informed decision. But in terms of voting rights and whatnot, it's pretty limited for the limited partners and the passive members.
Okay.
Nice. Thank you. Thank you. I see Mark's like, hold on, I got to take some notes here for myself before I get to the next question.
Yeah, I'm taking notes and I'll also jot down some questions. So I do have a piggyback question, if I may. Can investors cash out early in the funds and funds? I know that in a regular fund, investors have the option, you know, some operators allow the investor the option of cashing out or selling their shares within 4 years and collecting whatever is owed to them. Can that also, is that the same scenario in a fund of fund?
Yeah, it's pretty similar rules. What you just have to be mindful about if you're doing one of these two offerings, you're paying attention to whoever is eventually invested in your security, right? So let's say you do this 506B offering. Some of the constraints there, you can have up to 35 non-accredited investors and then an unlimited amount of accredited investors, right? But there is no open solicitation, so you can't blast your offering on Facebook or LinkedIn, or you can't buy an email list and just shoot it out on distro to people that you don't know. But what's important here, just by way of example, is if you have 35 non-accredited but sophisticated member maximum, you want to make sure that that interest isn't being transferred to somebody who would potentially blow that number. You also want to make sure that you vet, right? So in our operating agreements or in our partnership agreements, we make sure that the interest can't be transferred without approval by the manager, right, or the general partner. You want to make sure you vet any of that potential investor transfer, where that's going. The idea being, when your purchaser of your security is buying it, we have them make an affirmation and subscription agreement, and as part of the operating agreement, that they're buying that for their own interest, right? They understand it's a 4 or 5 year hold period, or whatever it may be, and that their interests aren't freely transferable. And so just make sure that whoever you're dealing with on the legal document side of the house, capture that in your subscription agreement. Because at the end of the day, you want to make sure you have control over who they can transfer that to.
Understood. Awesome. Now, is there a minimum amount that can be invested into a fund of funds or an SPV of sort?
That's not really a minimum. I think that if you start to get into increments that are pretty small, I mean, just imagine every investor that you have come to the table, that's another mouth to feed, right? Both in terms of just attention that you give them, right? The amount of communication involved. I mean, for us, the kind of standard minimum is 50 grand or so, especially for the first handful of offerings. We do write in that you have the discretion to make that a smaller increment if you want to, right? So you as the manager or the general partner can decide if you are selling off interests at 1% at 50 grand, but somebody wants to come to the table with 0.5% for 25 grand, you have the discretion to do that. But that's kind of the industry standard now is 50 grand or more, just because of the amount of the volume of work that you have dealing with each investor, right? Now, what I see is pretty common. If you have people who want to invest, but they don't have their own 50 grand, maybe they've got 15 grand and another buddy has 15 grand and the other person has 20 grand, they may well form their own special purpose entity for the purpose of investing in your fund of funds. And again, now you're only dealing with one entity as opposed to three, a little bit less hassle, less maintenance. So that's really up to you.
I just want to hop in here real quick and say, loving the way this interview is going so far. Both Marc adding great value add questions, Byron delivering the goods. Just want to hop in here as a little, I guess you could say, marketing or advertising plug as we make our way through. So first, I just want to give everyone an opportunity to check out your website, Byron. I know you mentioned one before we went live, but are you guys taking new clients right now as far as like on the legal side? Because I'd want to drive traffic there if you are.
Yeah, we are. So we've been pretty busy, guys, sharing with you before the show. It's been a very, very busy month for us, but we have a good team, pretty responsive. But yeah, so our website for the firm is just www.3pillarslaw.com. So you can check us out there.
And then on the capital raising side of the business, you guys are, fill us in there.
Yeah. The investment side is our company is called REI Keyholder Limited. So it's www.reikeyholder.com. Cool.
Thank you. And then Marc, where would you like to drive traffic?
I can be found on LinkedIn. LinkedIn.com/in/Marc Cesar, MarcCesar. I try to get back to everyone with any question or queries as soon as I can.
Love it. All right, back to the questions. And I know you had one ready to go there, Marc, and I cut you off. So let's keep it rolling.
No worries. This is also to piggyback from the last question. So I do see a lot of companies such as Fundwise and other well-known brands out there that I presume they're doing sort of like a SPV or a fund of fund. And if I'm wrong, feel free to correct me, Byron. But how is it that they are allowed to collect as little as I think I've seen Fundwise accept an offering as much as $500 to invest in whatever project they're working? Can you sort of give a little background to that and how, if someone's looking to start a fund, how they're able to structure it and do it that way as well?
Yeah, so I assume we're talking about a crowdfunding platform, and that's kind of where I was going to dovetail next. If you're looking to take monies less than 25K, 50K increments, that may be a route to go. It's you use a third-party crowdfunding platform, a little bit more regulation. I'm going to be frank with you, I haven't done a lot of work with that. We did a few years back, but I spend the majority of my time trying to focus on a real estate side of the house and maybe portfolio offerings or the fund model. I don't really get into crowdfunding too much, and that's simply we just try to focus on what we're doing.
Awesome. Side.
Marc is taking too many notes. You got to pull the questions back up.
Yeah. So another question in our queue is, what is the right thing to do if the GP shares changes after dropping a PPM? New membership or different split? How would you suggest someone deal with that scenario?
So I'm trying to think in a fund of funds model how you would change the GP share. I would tell you on the SPV side of the house, when we purchase a piece of real estate, how we typically tee up our offerings is we'll figure out what's the minimum offering that we need in order to make the project go, right? And so I'll use a multi-use property that we have as an example. We knew that we had to take down, I think it was $475 to purchase the property. The plan was to develop some additional land. So that was enough to purchase. And then if we had to, worst case scenario, either secure additional commercial debt or do a subsequent raise at another time, or just fund the development from operations, right? And then on the max side of the house, for our maximum offering, I think we had 750 grand, and that was to give us enough money to do the development work we needed to do, all of the soft costs, engineer plans, architect plans, permits, right? And then the actual infrastructure and purchase of additional units. But we'd be able to fund that internally at the 750,000 side of the house. And so the way we build up those offerings are we sell interest up into a certain point, and that interest, each 50K increment would equal a certain percentage of the ownership. Now, if on side we hit the low side of the raise, I'm probably going to go have to sign on another bridge loan, find additional monies. If we raise more monies on the higher side of the house, we're giving up more equity, but that's okay because returns will hit a little bit faster and gives us enough cash to work with. I think on the fund of funds model, it's a little different because you don't have as much, I think, meat on the bone to play with it, right? You know what you're going to get for your return, what's projected. You have enough to take a little carried interest and a few fees, but I don't see a huge change in what the GP share would be. Does that make sense?
Yes, definitely does. Thank you for answering that. Another question we have, between 506B and 506C, from your point of view, when should an operator go for one opposed to the other?
So I think you typically see the 506B offerings in the first kind of handful of offerings that a person's doing as an issuer or sponsor. I mean, that's just the nature of it, right? Any small startup, you're looking for friends and family money. So it's people that you know. And that's, again, one of the requirements of 506B is that pre-existing relationship. Just a side note, pretty important here, this is what a lot of people miss is you're supposed to have this pre-existing relationship prior to making an offering, right? But the rest of that definition isn't clearly defined. But at the end of the day, if you're limited by having a pre-existing condition first before you push out marketing and offering materials, then yeah, logically it follows you're talking about friends and family and maybe people that you've met in these various meetup groups and this and that. So it's a big social network that you have that then you can filter through and find potential investors. On the Charlie side of the house, you have a track record. So maybe you've gone full cycle on a couple deals, or you have some sort of development experience, right? And you've seen a deal through to completion. Now you have a track record, and you go talk to some of the heavier hitters on the investment side of the house. That's typically what I see. It's rare that people will jump right into a 506C offering unless they have a team together that has potentially shored up some weaknesses, unless they have, let's say, a family member who's fairly wealthy, right? I mean, those are the rare instances where I've seen somebody do a 506 Charlie right out the gate.
Okay.
This is important as well. Sorry, Mark.
No worries.
The SEC also has various look-through rules, and this is kind of an important thing. So on the fund of funds side of the house, if somebody's, let's say the senior off is a 506C offering, and you set up your own fund of funds, your own special purpose entity, and you try to raise money through a Bravo offering. Well, what you're effectively doing is putting that parent offering at risk, right? The SEC is going to look through and see what are the membership interests in your fund of funds. And if they look through and there's non-accredited, even if they're sophisticated, but non-accredited investors in that deal, that puts the parent offering at risk. So you definitely got to be mindful of that.
Awesome. Okay. Can someone, I just want to make this as clear. I'm pretty sure you probably answered this early up in the questioning, but can someone raise capital for a 506 Bravo deal without being part of the GP? Pretty much fee-based only. How is that viewed by an attorney / the SEC? And the second part to that question is, how do we as GPs work it out legally? How that is having someone raise the capital for a fee rather than a GP equity?
Yeah, so I think that's where we're getting back into that realm of the broker dealer, right? So as it stands, there's not really a way to do that appropriately. This pending legislation, um, who knows? It could change. It could change that structure a little bit and allow for people to get compensated for bringing some introductions or bringing some money to the deal. But outside of being one of the principals in the group, and even then, you're not looking to be compensated solely for bringing money to the deal, right? There's got to be some other activities other than being compensated. So here's what I mean by that. And this is pretty common right now. And so you have 3 or 4 acquaintances or people in a network that want to pull together a fund of funds model. The typical structure that we use now is they will participate as the general partnership group, paying up their roles and responsibilities and how they get compensated. We'll do a separate, some people call it a side agreement, some people call it a joint venture. We'll do a separate agreement between those parties as to how they're going to divvy up responsibilities. But I always make sure that it's clearly defined. It's not just for bringing money to the table, right? So if you have, Adam and Marc and Byron, and we're going to co-GP a deal, the offering documents are going to be investor-facing documents. And so the operating agreement is going to really deal with the functioning of the company in terms of how you're taxed, what the distributions look like, what voting rights do you have, if any, as a passive membership interest. Those are the kind of workings of the company. And that's what the investors are going to see. But in terms of what Adam and Marc and Byron are going to bring to the table, we would have a separate agreement. And perhaps Adam is responsible for investor updates, and Byron's responsible for bookkeeping, and Marc is responsible for project management or whatever else, right? And so you don't want that carried interest that you get as the GP to be solely reliant on bringing money to the deal.
I got a follow up one on that, Marc, before we go. But I mean, have you seen? I feel like you've seen enough deals to know the power of this, and I feel like I already know the answer, but I just want to hear your take on it, Byron. I mean, how crucial is it to make sure that the GPs understand who's responsible for what?
Yeah, I think. Well, me personally, I think it's important just internally to clearly identify who's doing what, right? And just part of that, if you're loosey-goosey on who has what responsibilities, stuff falls through the cracks, that can be problematic. And one of the things I mean by that particularly is investor communication, right? So that's probably the number one issue that investors have, is they feel like they haven't been, everyone's communicating until the money is wired, right? And then after that, the wheels come off and there's a lack of communication from the issuer or from the sponsor, right? So I think you definitely want to cover down on who's responsible for communicating to investors, right? What information is going to be communicated. Like, we would put that in an operating agreement, but also in a joint venture agreement, who's responsible for pulling together the pro formas and providing those to investors and show how their investment is performing related to what the forward-looking statements were provided in the offering documents. Who's responsible for tax preparation, right? This is a big one. If people are investing through a special purpose entity into your offering, their tax documents, their filing is due on March 15th. So if you're not getting K1s out to these guys, then by default, they're probably going to have to file an extension. But if you do have somebody who's bird dogging tax preparation and making sure they've got everything buttoned up by the end of the year, and you can get it out by March 1, that's significant. Who's managing the investor portal? Who's making sure that preferred return is starting to accrue from when we say it's going to accrue in the offering documents, right? Those are things that are pretty important that I suggest you spell out in a joint venture agreement.
Thank you.
So basically, it's safe to say, for everyone listening, that you want to have some kind of role that you're playing in the GP to not sort of be considered as a fall under the umbrella of broker agent relationship. If I'm correct, am I correct, Byron?
That's what I advise my clients.
Sweet. Awesome. Let's see. What kind of communication, that can be language or approach, should not be used for raising capital for a 506 Bravo syndication?
So in terms of the type of communication or the content that you're putting in your documents, right? Let's say your pitch deck. Not a ton of difference between what you would do in a Bravo offering and a Charlie offering. It's, at the end of the day, it's enough the investor make an informed decision, particularly when you're dealing with non-accredited but sophisticated investors, right? So in a Bravo offering, you're not necessarily required to give information to your accredited investors in that deal. But if you do, you've got to give that same information to your non-accredited and sophisticated investors. But at the end of the day, one, I think you want your forward-looking statements or your pro formas to be grounded in reality. So if you're operating in a certain market where average rents for a Class B apartment are whatever, $1,500 a month, and that's part of your business plan is turn a Class C to a Class B, but all of a sudden your pro forma say you're going to get $2,000 a month without any supporting documentation or analysis, I would steer clear of that. Right? The overarching, I think, over deliver. And I think if you can't do that with your financial models, then I think it gets a little risky. But also, I think from an investor perspective, that's what you want, right? You want the deal to outperform the figures that were provided. So just generally speaking, being conservative, but making sure your returns are grounded in reality, right? That's important. You definitely want some disclaimer language, like on a pitch deck, for example, that this 506B offering is only provided to people that have a pre-existing relationship with your company. And that if it gets forwarded to somebody who doesn't, then disregard. You can't make reliance on this document because, again, we want to protect that pre-existing relationship, right? In the digital age, it's a little different now, but it used to be you would have an offering document and you would actually have a number assigned to that PPM and have the investor name. So if you have 35 investors that you're gunning for, you put, number 1 through 35 on each of those subscription agreements and those PPMs. And that way you're able to track those to make sure. Nowadays, I know it's really difficult because people forward through email. And at the end of the day, if people don't understand that concern about forwarding information or open solicitation, you may push it to somebody who doesn't have a pre-existing relationship with Marc. I mean, that stuff happens. But just make sure that on your offering materials, you have those disclaimers. Something that's really important on the 506B side of the house, and this is, a little bit of a segue, is how do you determine this level of sophistication, right? Because that's not a bright line rule there. So one of the things that I advise our clients to do is you have to have an investor questionnaire regardless, right? So they've got to fill out an investor questionnaire that says, are they accredited, yes or no? And then you, as the issuer or the sponsor, have to make a reasonable effort to determine their level of sophistication, right? So what does that mean? Of course, there's not a bright line rule, but what you're generally looking at is the person's level of education. And it could either be something, post-secondary, graduate school, doctorate, whatever. But it can also be certain certifications that people have received. If somebody's been a real estate agent for 10 years, at the end of the day, you want to make sure they have the level of sophistication that they can understand the risk associated with the deal and do a proper evaluation as an investor, right? So one of the things that we do both on the investment company side of the house, but also advise our clients is you can do a questionnaire. A lot of people just take a form-based questionnaire, like a Word document or something like that. I like to use, there's 2 platforms, FormSite's one, Microsoft 365 has Forms as one of their programs, but there's plenty of these form-based web-based platforms you can use. And I'll actually tee up a questionnaire that asks all the questions on whether or not they're an accredited investor, but then I'll ask them to fill out additional information that does a couple of things for me. One, it establishes a pre-existing relationship. And so I'll ask them, who do you know out of the principals out of this offering, and how long have you known them, right? And I'll ask, what are your investment objectives? So even though that's not required by the SEC, now it lets me know what type of offering I can give this person. If they say they really like mobile home parks and RV parks, well, then if I see an offering, then I know that I can hone in on that person a little bit. And then I ask them to give some information on their level of sophistication, right? So how long have they been investing generally? How long have they invested in real estate? What's their highest level of education? Do they have any special certifications, right? But I'll get them to fill that form out, and then it'll just produce an Excel document for me, and it'll show me, okay, I've got all the information I need on whether or not to send this person the offering documents. Now there's platforms out there that people are using, IMS and Appfolio and Groundbreaker and whatever else. We'll do a lot of that stuff as well. But if you're just getting started out and you don't want to spend, $300 to $500 a month, there's a very simple way to help your potential investors do some of the lifting for you.
Awesome. So just to wind it down, the final question is sort of like a 3-part question. I hope that's okay, Adam. So
Go for it.
It is, what is the benefit of establishing a fund of funds? That's the first part. How is the fund structured? Investors compensated and protected from loss of funds? And the third part is, will we start seeing more operators or companies establishing fund of funds in the foreseeable future as a way to buy multifamily assets?
So I think the benefit is if you have access to investor capital, or you have something systematized, right? So like what Hunter and Adam, what they coach and train on, how to systematize raising capital, right? But maybe you don't have the interest, or you don't have the geographic proximity, or you don't have the team to actually manage, like, let's say a real estate project, right? I mean, that's a heavy lift. Even a light value add on a 100-unit apartment complex, that's not a light lift. So if you have all those other bells and whistles in place, but you don't have the bandwidth, or you don't have a general contractor or somebody who can do that for you, I think the fund of funds model is good. If you have organizational skills and you have the marketing machine set up and ready to go, and then you can, as an individual, underwrite certain opportunities, I think that model works really well, right? And you could probably have a smaller team when you're doing it. You could probably outsource some of the bookkeeping or the tax work, right? You can outsource some of the distribution stuff and just stay focused on what those core competencies are. If they are putting out content on social media and establishing yourself as a thought platform leader and whatnot, then I think it's a good model. How is it structured? I think pretty similar to what we talked about on the SPV or SPE side of the house. So you typically have an entity, same sort of thing. You're managing a company, and in terms of compensation, it really depends. I've done various fund of funds for different people that were derived from the same parent fund, so to speak, right? And people put a different tilt on it. So there's not really a one size fits all approach, right? But again, we're framing the fees in a way where you're not getting compensated for the amount of money that you raise. It's for the different operations and activities that you're doing, to include the administration of the fund, right? So all of that stuff. So you would identify, me personally, I like to provide the information from the parent PPM, or at least make it accessible, right? Because your investor should have the obligations or the opportunity to see what fees you're paying into that parent fund to participate in that deal, right? From the capital you guys are going to deploy. And then you want to disclose your fees, right? This is kind of the information you have to have. And so We put in it's called a sources and uses table. And we put in a description of the manager's compensation. So sources and uses table, we're looking at, if I raise $5 million, which was my target, I'm going to deploy, 4.5 million into whatever this fund is. And the remainder I'm either going to take as, sponsor fees, asset management fees, acquisition costs, like whatever that split is, right? So when you close your offering, you got to show where's that money going to go? And then in addition to that, if you have fees, they're going to be a line item expense on an ongoing basis, like an asset management fee, so to speak. You want to disclose that as well. So you basically want to show how the management team is being compensated. And then from the investor perspective, what are they getting? Well, that's your forward-looking statements, right? So you're taking the projected returns from the parent fund, and after you pull out whatever fees you're going to get either at the front end or on an ongoing basis, now you determine what the investor return is.
Awesome.
Awesome. I can see Marc's kind of like just getting warmed up. I think he needs you for another hour, Byron, but we're gonna start winding it down now. Just want to first of all, thank you to our audience and listeners for joining us here today on really what I think we're going to go with the title of this episode of Fund of Funds 101. Action-packed, value-packed, and as I said, at least a $650 interview. So one more time, Byron, Marc, we'll go in that order, Byron and then Marc, give our listeners a place to just go follow up, get in touch with you. Byron, I know, on the investment side of things too, you're pretty active, which it's pretty cool to see that, you're able to, it's two businesses that kind of go hand in hand. So I love that. But yeah, go ahead and drop us or give us the URL so we can put it in the comments, and then Marc, we'll move over to you.
Great. Thanks, Adam. So on the legal side of the house, it's the number 3 pillars law.com. Again, we're in Castle Rock, Colorado. I think there's 1 or 2 3 pillars around the world, but we're the one in Castle Rock, Colorado. And then on the investment side of the house, we're reikeyholder.com.
Cool.
And my contact information is on both. Be happy to chat with you, but appreciate the opportunity, Adam. It's a lot of fun.
Absolutely. Thank you for taking the time to invest in our listener and just viewership base as well. Really happy to have you here. And then Marc, I know you've got your meetup every Monday night on, you can tell us where to go. And I think you said LinkedIn as well, but I'll pass the mic to you.
Sure. I appreciate it. Thank you, Adam. And Byron, thank you so much for educating us. I definitely learned a lot. Just wanted to give that shameless plug. I can be reached on LinkedIn for certain. That is one of the main platforms that I navigate as of late. So Marc Cesar, MarcCesar on LinkedIn. My meetup is every Monday, 7 p.m. Eastern, Financial Freedom Through Apartment Investing. You can definitely check it out at bit.ly/FFTAI. FFTAI. Thanks again, Adam.
Nice. Thank you, Marc. And yeah, highly recommend everyone to pop in there, check out Marc's meetup. He's been doing it for a few months now, very consistent, and always some value to be had there. So if you got nothing going on a Monday night at 7, go hang out with him. And most importantly, I'd say thank you again for investing your most valuable resource with us here today, your time, as we got to interview 2 amazing people here on Dream Chasers. My name is Adam Carswell. I almost forgot, guys, I wouldn't know Byron if it wasn't for Raise Masters, the #1 mastermind for elite capital raisers. So for more information on Raise Masters, you can always go to raisemasters.com. I guess before I sign off though, Byron, Marc, again, and we'll go in that order. Any parting words of advice or wisdom to our listeners?
Yeah, just from the investment side of the house, just get in the game. I see this is why I love the Raise Masters group, because everyone is getting after it, right? I deal with a lot of people that hem and haw for years on end and never actually do anything and miss out on a lot of opportunities, right? Because they're so risk averse. Just do it the right way. And when it comes to the riskier side of the house, believe me, a little bit of investment money up front, talking to an attorney is worth your while for sure. At the end of the day, you're probably going to recoup that expense when you do your raise. So it's a little money out of your pocket up front, but to frame your offerings in the right way, stay out of the realm of that broker dealer stuff. It's well worth the investment.
Nice. Thank you. Marc.
Just to piggyback off what Byron said, simplify it enough. If you're looking to stay out of jail and last long in this business, re-listen to this and make sure you jump on the call with Byron. It's worth it. That's all that I can say.
There we go. Love it. Thank you, gentlemen, so much. And we'll sign out here. So, ladies and gentlemen, thank you for tuning in. We'll catch you in the next episode. And remember, in all you think, say, and do, take it to the next level. Thank you once again for investing your most valuable resource with us here today, your time. If you enjoyed today's episode, please drop a 5-star rating and a review below. Take a screenshot of it and send it over to nextlevel@carswell.io. We have a present for you. We really appreciate you guys leaving those reviews because it really helps with the overall SEO and visibility of the show and allows us to continue to bring on high quality guests. So once again, thank you. And remember, take it to the next level.